Daily Energy Markets podcast. It is Thursday, June 8th. Oil prices opening a little bit softer in Asia this morning. If you like a sort of a after the initial sugar rush, or shall we call it the lollipop rush on Monday morning, the prices have sort of sobered back to kind of pre-OPEC meeting levels of, at least on Brent, in the sort of mid 70s, or give or take a little bit. Everybody has to have a chance to comment on the big news of the week. It is Thursday, but the momentum out of the big OPEC decision is still lingering, and I'd really welcome everybody's views on that, because of course the legacy of it is this sort of question mark now of the Saudi 1 million barrel a day cut. The sort of the only really tangible takeaway from the meeting in the immediate sense was this commitment by Saudi to unilaterally cut their oil supply in July next month by a further 1 million barrels a day for 1 month, and the outlook for that continuing, I suppose, is where the next big question mark arises. But I welcome everybody's view. We've got to sort of literally span the globe this morning. Let's start out in the wilds of Asia, far Asia, in terms of Peter McGuire in Sydney. Peter, Chief Executive Officer of XM Australia. Peter, your thoughts 4 or 5 days later, having a sober reflection on the weekend drama.
Well, good afternoon, Sean. Good morning, Sean. Good morning, fellow guests. Greetings from Sydney. Yeah, it popped heavily on Monday morning, and I thought, here we are off to the races, up 4.5%. And it's, 9 o'clock, 10 o'clock Sydney time. So where you are, it's like 2 a.m., 3 a.m. Dubai. And then if you're further east, or further west, then, you're probably seeing that late Sunday night. And it popped heavy. And I thought, wow, here we go. And the shorts would have got absolutely spanked. And it gave up a little bit of that later in the day. It came back about 1.5% or so. And it's still a reasonably very strong Monday. Where I sit here, as you mentioned, 76.80, Sean, for Brent, 72.25, 72.40 for WTI. I'm curious to see how Saudis play out. I understand that the UAE or the Emirates were the winners in a lot of ways. They got an extra 200,000 barrels a day of production. And the other side of it, Russia didn't get crimped. There was no real talk there. So I sit here and go, as far as my understanding is, Saudis want 80 to 85 to 90 and see if we can do it. US dollars coming back, Sean, at 104, and it's giving up a bit of heat, but we've got a big week ahead of us next week. Maybe Jay Powell and his team might ratchet it up again.
Narendra Taneja, India's leading energy expert. Narendra, your thoughts a few days later. Do you think OPEC Plus comes out of this meeting? Now, obviously, a number of years this OPEC Plus has existed. Does it look strong and robust to you, OPEC Plus, or is this a weaker OPEC Plus? Your thoughts?
Well, OPEC Plus to me looks like weak and divided. Because Russia is, of course, has got this great opportunity to expand in Asian markets and big Asian markets like India and China, and of course beyond India and China, also in Turkey and Pakistan and several other geographies. So for them, it's all about market share now, and at the same time revenues. But for Saudi Arabia, on the one hand, Saudi Arabia wants oil prices to be in the region of $85 per barrel minimum. And at the same time, they want to protect their market share in geographies like India and China and beyond, of course. So it's a bit of a struggle for them. On the one hand, you want prices at 85, and on the other hand, you also want to secure market share. And the fact is, on both these points, they're losing. They're losing market share in many Asian geographies in particular, and they're also not able to basically bring the prices where they want to push the prices up. So I think it's a bit of a struggle for them. OPEC itself is a divided house. OPEC plus Russia is moving in two different directions. And so therefore, importers such as India, it's a kind of a little bit more comfortable spot in the sense that when the prices are not really where Saudi Arabia, in particular Kuwait, Iraq, they want it to be. And at the same time, India has this possibility to buy oil from other geographies, more particularly Russia, because it works out well for economy. So I think OPEC plus right now, we don't know about tomorrow, but right now it's weak and divided, and OPEC also kind of looks weak as we, when we look at it today. But this is not to say that it's going to stay like this forever. This will change very soon. The ground reality, especially in terms of geopolitics changes, and also the overall demand for crude globally. So there are many other factors. But as of today, yes, weak and very confused.
Dr. Rad Al-Qadiri, Managing Director, Energy, Climate and Resources at the Eurasia Group in Washington, D.C. Rad, your thoughts a few days later, divided, weak, as Narendra indicates. Do you concur? Surely Saudi Arabia didn't go to Vienna. I would be surprised if they got the outcome. They went to Vienna, brought the whole OPEC circus together for the outcome that was delivered, and leave OPEC or leave Vienna carrying a very heavy bucket on their own. Your thoughts?
Yeah, I mean, it's hard to work out what the Saudis did want in Vienna in some senses, but very clearly, it's trying to balance that pressure of very short-term oil markets, something that they've tried to avoid getting involved in sort of in the past, because really they don't have very many sort of agile tools to be able to influence sentiment in the very short term. Versus, I think keeping the organization together and really taking advantage of where they are. I'm not sure I would have characterized them as necessarily weak and divided. I think there have been times when OPEC has been sort of far more internally divided than it is right now.
Well, OPEC plus really is the focus here rather than OPEC itself.
No, absolutely. And I think, the point there is that, while the Russians may not be complying in terms of cuts, they can't actually step in and take new market share because there are ceilings on their production. So I think, it's not to say that OPEC Plus is a house that, or an engine that's working, an engine that's working smoothly. But I think, that ability to manage Russia in the short term, where I think we are is, in an odd sort of twilight zone. Fundamentals probably didn't point at the carnage that we saw in May in terms of prices. I mean, that sort of $10 drop, or sort of almost $10 drop on average prices that we saw, can't really be related to sort of strictly to fundamentals. Sentiment clearly is playing a part. And I think that's the struggle that Saudi Arabia has. And that's where the 1 million barrels a day comes in. But this is a market that's, betting against higher prices. You and I, Sean, have been to enough OPEC meetings to remember a 1 million barrel a day cut sort of would be sort of seen as somewhat bullish in the market. And as Peter mentioned, it sort of, it took off briefly and then turned out to be a damp squib. So it's difficult to see what Saudi Arabia can do next and what OPEC Plus can do next. I think it's going to have, what the markets are waiting for, definitive signs that demand isn't going to crash, and demand isn't going to remain, so it isn't going to be weaker in the future. And I think until you get those definitive signs, I mean, it's the opposite of every cloud has a silver lining. In this case, every silver lining has a cloud, and I think the market is focused very much on the cloud, not the silver.
Peter, Rad makes a good point there. I mean, ultimately, this market, it would appear, is not really focused or concerned about supply right now. There seems to be enough oil around for everybody. This is a question around demand. Where is demand going?
Well, when you ask that, Sean, I mean, I'm just looking at some notes here. China's May crude imports jumped 12 to 12.2 million barrels a day, up 17% from April. And up 12% year on year. So let's park that, but that's not, that's not a negative number. That's up 12%. That's one hell of a big shoot to the upside. So there's that side of it there. Now, if we look at iron ore consumption and, their import, and that's a big concern to Australia, but it's a fairly extensive overview of the world when you're thinking as far as steel. I think their biggest month ever was March or April, China from Australia. So from an import sector. So either someone's not telling the true numbers, or I think appetite is still very strong, Sean. And I think Saudis, building on exactly what Rad said, and to some point Narendra, we are sitting here scratching our heads, and I think so are the Saudis. They just want to see oil prices. I don't think there's any way out of it with another $10 strapped to it at least. And I think we're going to achieve that over this summer period.
Narendra, sort of building on that sense of optimism, the bullish outlook, India India's stock markets are heading for another record level, with foreign inflows looking quite healthy. We have the Japanese stock Nikkei index equity markets looking very well, also getting back to near record highs. There is enough glass half full to look at that says demand is still solid here.
Oh, absolutely. I mean, if you look at India in particular, from Delhi, Bombay, Chennai, Bangalore, in fact, from any part of the country, it looks very optimistic. And if you look at the projections for the next quarter or the next year, or even the little bit medium term, like next 2 years, it all looks pretty good. And therefore, the demand is likely to go up. And at the same time, the way we look at China from New Delhi, we think that China is recovering and China is doing reasonably well. And within the next 6 months, our own analysis is that probably the demand will be back to more or less normal in China. And the same may go for a few other, countries in our part of the world, which are important in terms of demand for oil. So overall picture from here is good. But at the same time, we find that, what Saudi Arabia is trying to do at OPEC, or for that matter, a couple of other countries, to push the prices artificially up. Our sense is not, this kind of model is not sustainable. I mean, they might have their own need that Saudi Arabia, we see reports Saudi Arabia wants oil to be $85, $90 per barrel in order to sustain the kind of internal social and economic reforms and the changes they want to bring about. But why should the world pay for it? And the second question is that, the view from New Delhi is that there is no shortage of oil in the world. So there's plenty of oil available, there's plenty of gas available. And at the same time, we all know that, OPEC may try and OPEC may blind, but we think that Saudi Arabia is a little bit probably frustrated when it comes to OPEC plus, because Russia has to look after its own interests in the same way Saudi Arabia is trying to look after its own interests, or for that matter, Iraq and the United Arab Emirates. So I think we understand this reality, being probably the largest importer of crude oil on the planet, when you look at the emerging economies. Our dependence on, at the same time, imported oil has now gone up to 87.5%. So for us to, watch all these things with a microscope is strategically very important, which we do with regard to Saudi Arabia in particular, how the internal politics and how the internal dynamics, for instance, play out at OPEC meetings, and for that their relationship with Russia and other exporters. So I think our sense is right now, for next 2-3 months, nothing to worry about. Saudi Arabia is unlikely to succeed, artificially push the price. They may go on for this production cut and all that. But these are all kind of tricks we have known for a long time, or the maneuvers we have known a long time. But there is no discomfort right now in Delhi, and being the third largest importer, consumer of oil. But at the same time, it's important to see how things go in Ukraine. And we are more worried about Ukraine, further sanctions, secondary sanctions, and supplies and those kind of things. And of course, the refining challenges. So those challenges are kind of bothering us. Otherwise, at least for the next 3 months, we think the picture looks reasonably okay. It's very difficult to say what happened after 6 months and so on.
Sure. Rad, your thoughts on this question of, does Saudi Arabia risk sort of getting itself down a one-way street on becoming the swing producer again, that this commitment to the 1 million barrels, prices remain soft, they're kind of locked into continuing with it?
Yeah, I mean, that's always the danger, and that's my point about sort of the lack of agility, I think, in terms of trying to battle short-term market sentiment. And the problem with battling the shorts is, those shorts can move very, very quickly. In Saudi case, it's taking on or putting on oil, that takes weeks to hit the market, and is a very blunt tool. But more generally, I think to your point, yes, there is a risk. I mean, they can only go so far, and they'll only want to go so far alone. And I think, it may have been described as a lollipop. I think it was more intended as a cattle prod, to try and, shift market sentiment and sort of galvanize market sentiment, and really picking up on some of the points that Peter made, that, it's not all bad news. And yet markets, seem to dismiss anything that suggests that demand, if not extremely robust, is nonetheless growing in certain parts of China and certain parts of the Chinese economy. And, you know, while we've had poor numbers out of the US in terms of gasoline and distillate inventories up to recently, there's not really been a sign that, you know, the US or indeed Europe was a drag on demand. So, you know, a lot of it has been about anticipated bad news. And I think the Saudis tried to get ahead of that. But you can only do that a few times before you get really caught as the swing producer. And, you know, their memories are still there from the 80s when, you know, they've always vowed that isn't the place they wanted to be. And OPEC plus, and this is where I do agree with Navindra, OPEC Plus's sort of great success over the past 24 months has been its cohesion. And has been.
Do you think that, do you share the view that it is potentially, I mean, not fractured is obviously a big term, but ultimately there is a divergence here between this Russia's needs and appetite and the Saudis. And are the Saudis taking the hit here just for that cohesion piece rather than for their own real economic interest?
No, I think this is, look, every country in OPEC Plus operates on the basis of their own domestic economic and financial interests. You know, that's why it's not a cartel. You know, it's a group of fellow travelers that agree on some points and disagree on others, but ultimately will be driven by their own sort of domestic needs. And, you know, I think, yes, at this moment in time, there's probably sort of greater tension than there was sort of a few months ago, purely and simply because, you know, Russia's doing what, you know, any country in Russia's situation was going to do. It's trying to capitalize on its natural resources to deliver revenue when it's under sanctions globally. And other revenue avenues of revenue have been cut off. So, I mean, politically, it's understandable, and it does lead to that divergence. What I think OPEC has done with voluntary cuts, you know, or at least Saudi has done with voluntary cuts, whether it be April or this time, is tried to sort of circumvent that pressure in the short term, in the very short term. Again, it's designed to prod markets, but I don't think it'll do it too many more. I actually don't think it'll do it again. It may keep this cut in place, but it's not going to want to get sort of down to 8 million barrels a day of production or lower simply if the Russians and others are benefiting from that.
Peter, the other issues you mentioned in your earlier comments there, which have sort of fallen to the background with the debt ceiling crisis and now the OPEC decision sort of grabbing the headlines, but there is this thing called inflation and interest rates tightening. You mentioned the Fed meeting next week, the possibility of this tightening further and the impact. What's your views on that?
Well, I've just run Australia in the last couple of days, Sean, to bring everyone up to speed. We had April inflation running at 6.3, and everyone was saying that we'll probably see a 5 handle, and I think the most consensus was 5.9, maybe a 6. Well, it shot to the upside 6.8. So that really hit everyone between the eyes. Then on Tuesday, we had a rate rise of 25 basis points, our highest since April of 2012. And then yesterday we had GDP come out at 0.2. So it's soft here, and unemployment numbers are starting to hit from 3.5 to about 3.7. So that's an interesting examination of Australia. If I look at the US, obviously the inflation story, if I look at through the lens in Australia, it's not under control. It's actually getting worse. So I want to see the numbers come out of the States. I think that Jay Powell's got his hands full, and there's a lot of backlash across mid-America and Main Street with the inflation and the cost of goods and what the consumer is experiencing. And if Jay Powell doesn't move, and they're saying it's going to be about 80% probability of no rate rise, then that 20%, I think I'm going to sit in the 20% bank that'll probably see a rate rise by the Fed. So
what do you think? What do you make of this new term skip, the skip language that the Fed will pause for one meeting because they have very quickly another meeting in July. Instead of a 2-month gap now, there's only another month to the next meeting.
Well, that's right, Sean, and everyone's saying that they might be that skip, but I wouldn't be surprised that you see an uplift. But, you know, I think it's just the market, the US dollar's come under a little bit of pressure to the downside. It's back at 104. There's nervousness across some of those big stocks. Really, it's only the 10 out of the S&P 500 that are performing incredibly well. There's 490 that are languishing, but they're just such monsters that are spitting out cash by the handful. So the traders are looking at an interesting week ahead. That's all I'll
and of
say.
course, you had the very robust jobs numbers also last Friday, which kind of got smothered by the OPEC weekend. But ultimately, there's a lot of indicators there that would, give some. You would think more fuel than 20% for another rate hike.
Well, that's right. It went from 190. Consensus was 190. It shot to the upside 339,000. So it really hit everyone between the eyes. But people are even saying, well, it's people getting second, third, and fourth jobs. So there's well, there you are. So it's there's many ways to unpack or pull apart the artichoke. So it's an interesting test case at the moment, and I think this summer is going to be quite fascinating for the US.
Let's go to the survey question, which sort of touches on some of the themes we were talking about in summary. We sort of have spent much of the first half of this year with this year of two halves narrative, where Asian demand is expected to drive up oil prices in the second half, with the cycle of the annual calendar of demand going into the next winter. Do you still subscribe to the year of two halves narrative, where Asian demand will drive up oil prices above $80 in the second half? At what point you might say December 30th? Yes, but nonetheless, does the second half, this year of two halves narrative, still survive? Narendra, I wanted to just take a moment to just go a little bit local in India, because I think it is important. The raining season, the monsoon, and its indications, headline out over the last few days that it's started a little bit light, that not as much rain as you need. What's the outlook there, do you think, and how important is that?
Well, if you go by Met Office, depending which one, the public sector or the private sector, the projections are that monsoon is going to be okay. And while some people say that it might not be okay, so we'll get probably 70%, 80%, not 100%. But it looks like, if you go by the kind of developments we have seen in terms of weather the last 5 weeks, it looks like that probably is not going to be a normal monsoon, which means that when we don't have a normal monsoon, the demand for diesel in particular goes up, because then diesel is used for producing power, electricity, and in societies, in factories, and in far-flung areas, and even in the suburbs of the big cities. And also the demand for petrol goes up. So that's the kind of, if you go by the experience of the past. So, and which basically means months of July and August and half of September, probably the demand for petroleum products will go up from the non-transport sector. And that means by the factories and the captive power generation, so on and so forth. So I think that's my assessment, given the reality. But then you see that only God knows, or the nature knows. So we don't know. But it looks like there probably is not going to be an absolutely normal monsoon. We'll probably get there. Maybe we'll achieve maybe 75%, 80%. Some people say less than 70%, depending what part of the country, because we are a huge geography, as you know.
And just on the point also of the India's central bank keeping interest rates unchanged at 6.5%. I mean, it's still a very vibrant economy, inflation still present, but rates being held unchanged in India. Your thoughts on that?
Well, I think, I'm among those who've been against the central bank trying to, basically following Fed and increasing the interest rate, because what we need is more credit offtake. And what we need is at the same time to push demands mainly in the rural area. And that whenever there is a kind of, a growth in demand, we see the demand for petroleum products also goes up. And especially in areas outside the big cities and northern part of the country, eastern part of the country in particular. So I think that's a good decision by the central bank, because it's basically means the interest rates are going to be kind of more manageable, and people are going to borrow more for, construction, housing, and so on and so forth, and also for, expanding their businesses. So I personally feel the time has come, and the RBI, the central bank, must think over it, and at the same time, to the extent possible, try to reduce interest rate a little bit, because that is what the economy is basically now crying for. Economy is doing very well, but I think, there are companies and there are entities waiting for central bank to do something so the interest rate can come down a little bit. And because right now many companies find borrowing from Europe and foreign markets is actually cheaper. So because the dollar is always, so there are many other factors. Yeah. But my own sense is economy is doing well. an Indian central bank doesn't necessarily need to follow what they do in the United States. We have to
Right.
got our own thinking. We don't necessarily to follow them like a, like a tribe or like a lamb. So
Okay.
the Indian economy demands interest rates to be kept at this level for a few weeks, coming few weeks, and then they start going southward.
And it's still, I mean, it's still, it is a high enough level, 6.5%. So I think it looks like it would do its job. Rad, I wanted to get your thoughts. Again, the other big story that seems to be, literally burning in the background, the war in Ukraine, Russia's invasion of Ukraine, occupation of Ukraine continues with devastating consequences. It's hard to read the current status. It's a bit like waiting for the recession. We're waiting for this counterinsurgency, and then we had this terrible destruction of the dam over the last few days. Where do you think this is going and its ramifications?
I mean, I think what you're seeing is, this war settling into a very worrying pattern that sort of could mean that it goes on for some period of time. So I think, anticipation of the Ukrainian counteroffensive is still there. Has it started? Has it not started? Russia taking more extreme measures, obviously, and, as in the background, threatening even further escalation. I mean, I think the takeaway from this in terms of global markets is this is not a problem that's going to go away anytime soon. And in terms of, any notion that you're going to get a significant breakthrough one side or the other seems somewhat fanciful at this moment in time. And, it settles in and it remains both a disruptive element, but also a drag on various elements. So all that we've discussed this morning in terms of oil and in terms of, Russian oil policy, so long as the war goes on, there's very little to see, or very little chance that you're going to see Russia not try and put as many barrels on the market as it possibly can, because it needs the revenue. And similarly, it does have even longer term ramifications in terms of how it's changing the pattern of flows globally. And once those get sticky, could conceivably moving into a world of dual pricing for oil, moving into a world where politics, not markets, is driving the direction of flows. I mean, I think all of those sort of bear thinking out, probably not on a daily podcast, but from a very short-term point of view, nothing seems to sort of point to a breakthrough on one side or the other. Just simply more.
Given that you're in Washington and the U.S. election, the presidential election is slowly heating up there now with all of the Republican candidates more or less in the race. Where does the Ukraine, the sustainability of the Ukraine defense and the Western NATO position intersect with the U.S. elections? Is it an immediate sentiment of change, or how do you see those two coexisting now in the coming months as the election narrative heats up?
Well, being a renowned cynic, I think it all comes down to money, Sean, and ultimately that's where it's going to play out. The debate is going to be, continuously, how much money should Ukraine get? How much aid should Ukraine get? How much, how much defense support should the Ukraine get, and how much of it the US should pay for? And I think, obviously there are parts of the far right in the US that have questioned, on the Republican side, that have questioned US support for Ukraine and whether that's a priority or not. I think the backlash indicates that sort of the general feeling is still one that, it's an important issue to stand up to, and it's an important issue for the US to support the Ukraine moving forwards. But it's going to come down to money, and it's going to come down to a variety of other sort of issues, particularly when you're trying to put spending caps on. And I think that was the thing about the debt ceiling is, in the background, sort of one of the things that sort of came out while defense spending wasn't touched directly. It's a warning sign in terms of whether the US is going to continue to be willing to fund Ukrainian war efforts at the levels that it has been in the past.
Peter, last word with you and the survey result. I wanted to get your thoughts. So it's a 50-50. Wow. That's more or less where the market's at. Nobody has any idea. Peter, a lot of focus, of course, always on, and as it should be, China, Asia's biggest economy, the second biggest economy in the world, maybe the first when you take it on purchasing power parity and so forth. But Japan seems to be the one we should be paying a bit more attention to. Your thoughts from the economic outlook of Japan? Obviously, we've had the big story with the yen weakness this year, but everything seems to be moving in a positive direction there after some decades of stagflation and challenge. Your thoughts, just wrap us up today on that outlook for Japan.
Well, a quick history lesson, Sean. If we look back in history at 1989, 39,000 for the yen, and then it crashed to 8,000. And I'm looking
the Nikkei,
here
you mean?
Oh, the Nikkei, sorry, pardon me, the Nikkei. And now it's 31,641. It's just been absolutely on fire. And the last couple of months have been electric since really Christmas. So the Japanese economy, I think we've given up a little bit of steam on the yen, back at 140. And you might see it back around, that 141, 142, but it's going to be choppy. But the overall momentum to the upside for the Nikkei has just been extraordinary. And I think in a lot of ways it'll probably continue. There seems to be
the
a lot
ultra
of
easing policy will continue on the
I
central
think
bank?
so. I'm not looking for any surprises in the short run. Inflation's not really that much of a concern, and they've got, I think it's just booming at the moment domestically. I spoke to Tokyo the other day, and the general mood on the street is one of a fair degree of positive tone. So there's the momentum at the moment. Let's see what happens globally with equities over the summer. And if there's a washout, then it'll take Tokyo with it. But it's too early to call that yet.
I was driving into work yesterday, and there was talking about, as it is this time of year, travel, expats leaving the hot Gulf and so on. And it was like, where is the destination of choice this year? There's always one place, the new trendy place where people are going to. And the travel expert said, it looks like it's Tokyo. Everybody seems to want to go to Japan. That was his take. So I thought that was interesting. Why wouldn't it at 100 or 140 yen to the dollar? Probably some good value.
Absolutely, Sean. It's a great city to travel to, and it's the 34 million people make up Greater Tokyo. So it's exciting, and everyone should visit it.
We'll have to wrap it up there. Again, the sort of stubborn oil price hanging in its mid-70s. It's new barnacle on a rock. And unless there's something quite significant, it doesn't look like it's going to change. We'll have to wait and see. Rad Al-Qadiri in Washington, D.C., thank you so much. Narendra Taneja in New Delhi, thank you so much. And Peter McGuire in Sydney. We're all around the world this morning in 30 minutes. Not too many people doing that on podcasts. Thank you, guys. All the best.
Thank you, Sean.
Bye.
Thank you.
Cheers.
Bye. Thank you, Narendra.
Thank you.